There's another look at our national stock benchmark, the S&P TSX Composite Index, now up by more than 1/10 of a percentage point. So the upward momentum is growing slightly in the early minutes of trade on this Thursday morning, and that is very, very close to an all-time record high on the S&P TSX Composite, 25,524 points. Let's bring in our next guest. He's a familiar face to viewers of this channel, Ryan Bushell, President and Portfolio Manager at Newhaven Asset Management. Ryan, thanks for coming in.
Thanks for having me, Paul.
I don't think we've spoken to you since the bombshell of earlier this week, and that's Donald Trump pledging very steep tariffs on Canadian shipments. To some degree, we've seen this before. We've been through another Trump administration. Of course, where do you think this headed, and are there real takeaways here for Canadian stocks?
Yeah, my partner Steve and I were talking about this yesterday, and just it's an unhappy memory, right, of the previous time that Trump was in office, and a tweet would come out or a statement would come out, and markets would react to it right away. So we're back in this world of Trump-induced volatility that cuts both ways, frankly. There's going to be positives and negatives, but there's also the issue of what gets said and what gets done. And I think that's where we're at right now. We're in the stage of a lot of things being said. It's going to be harder to get them done. So we're trying to take a very patient approach with this, but it's we own a company called Severia. Yep. They export elevators into the United States for mostly in-home residential use, and stock was down 10% on the news over the last 2 days, and it's sort of like, I don't think their business has changed that much, actually. We'll see what actually gets implemented. There was a lot of toing and froing over the last USMCA agreement. Right. It ended up in a pretty good place. Hopefully that this is the same thing. Okay.
Canadian banks are going to report beginning next week. What's your outlook on that sector?
Yeah, so I've said this before, the run on the banks has caught us a bit by surprise with how strong it's been this year. Clearly, the combination of interest rate cuts at the short end and decreases for Canada across the curve is going to help mortgage borrowers as we head into this big refinancing period in 2025. But I still think it remains to be seen where that ultimately settles and how positive that actually is for the banks. At the same time, we're still dealing with commercial real estate issues on both sides of the border. So I don't think it's an all clear, even though a lot of the stocks are at all-time highs. So we're fairly cautious, underweight. We have been underweight for some time, and just trying to be patient again with this sector to see what actually happens. There's a lot of anticipation right now. We'll see what the actual results look like as we head into 25.
Do you have a preference between the banks and the life cos at this juncture?
So we're fairly balanced, but we're underweight both sectors. But we own, our selection has been pretty good. So Manulife's our biggest position on the life co side. Obviously, it's had a great year. And then on the bank side, big position in Royal, but also TD. So those have kind of offset each other. We think TD is investable here. It's going to take a while for things to resolve, but at that point, in the meantime, you're getting a decent yield, you're compounding the yield, and just like Manulife took a long time to re-rate, but then it re-rated all at once, we think the same thing probably happens with TD at some point in the future.
Viewers will know that dividends are a big part of your strategy on behalf of your clients, and for a long time you've liked utilities, and that has been a winning trade, certainly in the second half of this year. Do you expect that to continue in 2025?
It's interesting, and one thing we're really watching is the long end of the curve in the U.S. with all the changes with the administration. So we had a big move upwards in 10-year yields in the United States on the back of the first rate cut, and then as Donald Trump rose in the polls and then subsequently won the election, U.S. 10-year rates went from about 3.6% to almost 4.5%. They've retraced a little bit here. We think, based on the appointment of Scott Bessent as Treasury Secretary, to be maybe a bit more middle of the road in terms of fiscal policy. So we'll see what happens there. It's interesting, though, that utilities, which traded off last year when rates rose, did not trade off this year when rates rose almost to the same extent, right? We had almost the same move. We had 3.6 to 5% in 2023 from April through to October. We had 3.6% to 4.45% on U.S. 10 years in September, October, November of this year. So we do feel that the story that we've been talking about of just structural demand for power growth, structural demand growth for power in the United States and Canada is taking hold, and that's going to play out over a number of years. So we are not abandoning positions. It's a little harder to buy them at these levels, but we are continuing to average in.
You said recently that you've got a decent amount of cash to deploy in 2025. What would it take for you to start investing that money?
Yeah, so interesting for us, where we're kind of positive on this tariff news. When I talked about severity, and it's frustrating to have one stock, but we're largely underweight those manufacturing consumer companies that are, or actually have no weight in those companies that are, would be exposed to that. So when those types of companies that could potentially be hurt by this, if it actually was to be implemented, and or any economic weakness resulting from, tariffs are not, are traditionally not a good thing for economies and trade. And so there's a number of businesses that we would like to own at lower prices that potentially we could see lower prices as a result of this. So we're looking to deploy, into the railways, for instance. They've been weaker. We think they could be impacted by this.
That's the Canadian railways?
Canadian railways. Auto parts manufacturers, we've seen weakness on the back of this. So there's a few sectors that we would like to have some weighting in, that we've been concerned that the economy and the markets are at all-time highs. We don't really want to, we're conservative, we don't really want to buy that. So if we get some weakness, we'd like to deploy.